So we'll give it just a couple of minutes for everybody to filter in. Okay, great. Can I kick off now? So good afternoon or good morning, depending on where you are. Welcome everyone to our session on harnessing the power of UK investment in Africa's low carbon future. This is part of the London Climate Action Week 2022 with the theme specifically on Africa, COP27 due to be hosted in Egypt in November. So lots of really exciting stuff to talk about today. I have to start the session with a bit of housekeeping. First off, we're recording, which is great because it means that anyone who can't attend can watch back later. And second, this is not intended as any kind of financial promotion, and we will not be providing any financial advice. Anybody who's interested in investing on Energise Africa should really take the time to read the full risk warning on the website and also familiarise themselves with any risks specific to investment offers that they would be interested in. Having said all that, welcome. Welcome to our panelists and to the guests in the audience. I'm obviously not Lisa Ashford. My name is Isona Shibata. I'm Programme Manager at Energise Africa, standing in for Lisa at last minute because unfortunately she has COVID, but a huge pleasure to be here with you all. And just going to do a very quick round of introductions with the rest of the panel. Then we'll go into the panel discussion. And we've got about 15 minutes towards the end for Q&A. We will try and pick up any questions as they come up in the chat, but obviously also that time towards the end to cover anything that we don't manage there. So if I go to the panel for a brief introduction for everyone.
Hello, my name is Shah. I'm the Product Development Manager for Energise Africa. The focus of my work involves looking at meeting the needs of both UK-based investors and also SMEs based in Africa, and coming up with products and product designs and piloting those products which can meet the needs of both of those constituencies.
And Stephanie.
Great, thanks, Isona. Hi, everyone. My name is Stephanie Jones. I work for Good Energies, a Swiss-based foundation funding climate change mitigation in two key areas: access to clean energy and protection of tropical forests. Good Energies is part of Porticus, which manages the private philanthropy of the Brennickmeyer family of business owners. And I manage our clean energy work, which promotes distributed renewables for electrification in sub-Saharan Africa and India. Thanks for having me here today.
Hi, I'm Frank Aswani. I'm the CEO of AVPA. We are a network of social investors working at the intersection of finance and purpose. We bring together investors deploying grants, debt, and equity into the impact space, working across all the 17 SDGs. And this climate issue is a big priority for where we are trying to mobilize capital for impact, because as you know, Africa, whereas being a very little or small contributor to the global gas emissions, we are kind of some of the biggest victims of greenhouse emissions on the continent and the world. So really happy to be here.
Thanks, Frank. My name is Fabian Gilfidian. Currently work as head of finance for MyAgro. We deliver or provide a savings mechanism for farmers to save towards seeds, fertilizers, agriculture inputs, deliver those inputs alongside agriculture training in order to increase the yields and economic output and return for those farmers. We operate in Tanzania, Mali, and Senegal. Previous to that, I worked with Ulu Solar as Director of Finance. Ulu Solar is a pay-as-you-go company working in pay-as-you-go solar company working in West Africa. There, I worked with Energise Africa, scaling up the first debt for Ulu.
Great, thanks, Fabian. So as I kind of touched on in the introduction, we had COP26 in Glasgow last November, and COP27 is coming to Egypt in November. And throughout that kind of series of events, there's been a real focus on low carbon development in Africa. But also, I think, a lot of discussion around what is needed in order to finance that transition. And Energise Africa has been, a new innovation in terms of how we leverage private finance for that low carbon development. But Frank, I'd be really interested to hear, both from the perspective of your membership at AVPA and also from some of the initiatives you're supporting, why it's so important to leverage private capital from the UK and from other developed markets to support that low carbon transition.
Starting off at a very macro level, we as a continent are facing a huge SDG financing gap. Africa needs between $500 billion to $1.2 trillion annually between now and 2030 to meet our SDG financing gap. Traditionally, as you all know, we've been a continent heavily dependent on aid and government funding, both sources of revenue and capital, which we know are decreasing by the day. Our governments are hugely under pressure with growing public debt, especially to fund our infrastructure development. You know how much we owe the Chinese, for example. And aid to Africa has reduced, and that reduction has been hugely accelerated by COVID as more and more donor countries realize they actually didn't need the money back home. The other reason is because of a crisis of success. As more African countries move to middle income status, we become less needy or qualifying of aid. So it's really between a rock and a hard place in many ways. And so the big challenge that we as AVP are trying to address is how do we address at a macro level that SDG financing gap? And at a micro level, how do we support the sustainable financing of our especially impact SMEs who are trying to close that gap between where the government should be, providing service and the innovation that's driven by entrepreneurs on the continent. So in the context of us having the gap that we have to finance, we can't keep depending on aid or government funding. So the private sector becomes a really viable solution for us, or source of revenue for us. And so a lot of the work we do at AVP is trying to see how can we make crowding private capital into this space, and how can we, leveraging the grant capital we have, really de-risk social investments. So at a very high level, that's basically what we do. Specifically to climate, this is on the context of priority. Climate traditionally hasn't been a place where a lot of African investments have gone. We've got, as you can imagine, we've got big challenges in healthcare, in food security, and those kind of things. But increasingly, climate is attracting a lot of attention because of the consequences it has broadly on things like agriculture, and a couple of other things of our tourism sector. We are being very deliberate about now trying to make sure that we pay attention to that. There is growing initiatives at various country and government levels, especially with the COP meeting coming up, COP27 coming up in Egypt, to see what is the agenda that Africa will bring to that meeting. How do we make sure that our representation and voices are very clear? So we're working with a couple of governments to really try and map out, what is the call to action? What does success look like for that meeting from an African voice perspective? And that's something we're doing. But at a more micro level, there's quite a number of funds that are now actively looking to see how they can play in this space. More so, we're seeing a lot more work being done in mitigation and in adaptation. So there is a bit of room that I'm hoping we can get a few more investors to look at the adaptation space of climate action. And in the process also make sure with our very low carbon gas emissions in Africa that we keep that down, and we don't then dig one hole by filling another by investing in businesses that are adding to the global carbon gas emissions. So that's kind of where we are at the moment.
Great, and I love that expression that you use, crisis of success, because to me what that tells us is that there's a huge number of emerging commercially viable solutions, and that we are transitioning away from this aid model to a model where actually impact investment is a really wonderful opportunity and a great story to be telling about the continent. And as you say, I think huge opportunities beyond the mitigation, but also in the adaptation and the opportunities to invest there in natural capital projects and in agriculture. So I think, for me, that really segues really nicely into what Energise Africa does. We're a retail impact investment platform. We were set up with money from the UK government under UK aid. It's really focused on leveraging private capital from UK retail investors to support low carbon development, specifically energy access and solar power companies in sub-Saharan Africa. Our minimum investment amount is £50. And so we really think about how we can kind of demystify that world of impact investing and provide triple bottom line returns to our investors. But what does that actually mean? So to date, we've raised over 31 million in investments, and we've repaid 15 million to our investors. But for me, the real story around the triple bottom lines is that money has enabled over 870,000 people to gain access to electricity. We've supported initiatives that have provided solar power to nearly 8,000 micro, small and medium enterprises. And we estimate that as a result of the finance that has gone through Energise Africa, there's been nearly 16 million in additional household income generated, and something like 180,000 tons of CO2 emissions are avoided each year. So you can really see that we're looking at financial return as well as social and environmental return for our retail investors. We've been really lucky from more or less day one to be supported by Good Energies Foundation. So Stephanie, I'd be really interested from the perspective of an organization who's focusing on impact in emerging markets and really looking at base of the pyramid customers, what brought Good Energies to a UK-based initiative, and what made you think, and perhaps a little bit about where you see that going as we move into the next phase of crowdfinance in the UK.
Great, thanks. So Good Energies focuses on market-based approaches and building up the sector, in this case, distributed renewables, as I mentioned, in energy access. And that's the part of the market that Energise Africa is really focused on. So in the first place, the impact was really well aligned. In building up successful enterprises, and in particular, some of the smaller locally managed enterprises that sort of fall through this missing middle of funding that's going into the sector. So that was our first draw, was the impact. The second is, in the world of finance and the flow of finance, philanthropy is still a very, very small part of it. So the leverage that we can get in working with a partner like Energise Africa is really important for us. So across the platform to date, we've seen approximately 8 times leverage of the philanthropic money that's gone in to Energise Africa, which then is matched or leveraged with 8 times the private capital that comes in. We think ultimately the leverage will be even higher when the philanthropic capital is no longer necessary for individual investments, or it promotes investment from other people out in other platforms. If it changes how people are thinking about investing into this sector, the ultimate leverage will be much higher. And that's just dramatically higher than what we could get if we were to invest in directly or make loans directly to some of the enterprises that are being supported. We're just not set up for the small deals that need to be made, and we would lose that leverage. The third main reason is de-risking, which we really think is the ultimate aim of philanthropic capital, the kind we have. We embrace the risks that others aren't willing to take, whether it's commercial investors or private investors or even other philanthropies. Good Energies is relatively small, so we start with the things that are really unknown and unproven. And in this case, trying to draw in investors, as you said, who aren't so familiar with this area, who don't understand energy access, who haven't invested into Africa. This is a way when Good Energies philanthropy can be provided as match funding, or a portion of a guarantee to a loan, and that draws people into this market that otherwise wouldn't be there. And as mentioned, hopefully then that philanthropic capital can pull out later. So those are the three areas. Where we see this going, I think Shaw is going to talk later about some of the new products and how we can continue to sort of shift the risk from the parties that can least afford it, right? The enterprises, or in some cases, even the investors, shift it more to philanthropy and use some of the commercial facilities in the market to do that. Overall, I see retail investors, as well as the conversation around ESG and commercial investors, wanting to do more good with their money. So not just avoiding sort of the bad climate negative things in the world, but to actively search out the climate positive and development positive investments. And Energise Africa is a great platform for retail investors to do that. And I think that's part of the overall movement towards shifting capital to doing more good out in the world. I'll leave it at that for now. Thanks.
Yeah, I think we have to, be very honest and praise Good Energies for being that kind of risk-taking, very forward-thinking, very innovative philanthropic capital. I wish we could see more organizations like that really taking the lead and thinking about how we can de-risk and leverage private capital for initiatives like Energise Africa and like the many solar paygo companies that we've been able to support. I think, also really interesting to see how, from Energise Africa's perspective and experience, the support of organizations like Good Energies and UKAid has helped to build the trust and the interest of, the retail investment audience here in the UK. As you say, for a lot of people, this is a new area and a new space. So it really helps to kind of bring them in and quite literally crowd in private finance. So you touched briefly on how Good Energies is currently supporting our next round of product innovation. And, you know, as in the previous support you provided, which was really around how we attract investors to the site, we're now moving into a kind of next round, which is really thinking about how we can develop products which are more appropriate to small and medium enterprises in the region, and what we need to do to offer them the kind of flexible and affordable finance that they need to grow and achieve scale, to achieve social and environmental impact. So Shah, perhaps I could hand over to you to talk a little bit about where that's going and what we see on the horizon for Energise Africa.
Yes, so I sort of going down to a little bit more granular detail level. I think the first thing to say is where we're currently at and where we would like to get to. So in terms of where we're currently at, in terms of our core product, typically it is a bond. For the purpose of this, we can call it a loan note. It is issued to investors. That bond typically has a maturity of 24 to 48 months, and has interest and is repayable semi-annually by the borrower, the investee. The borrower is typically would purchase solar home equipment in Africa and then lease that with a service plan to households in various countries in Africa which don't have access to energy, so they actually have a source of energy. I've mentioned that for a particular reason, which I'll come back to. So at the moment, the borrower has to repay that debt in sterling, and that is the capital interest that the UK investor receives, which is also in sterling. So you as a UK investor go onto the website and you may subscribe for say a 6% yielding bond, and you'll be expecting that to be repaid in sterling. So the problem that we have is that for the borrower, we have to look at the currency, which is the currency or currencies which they'd really like to borrow in. And we have to look at the relevance of those currencies, the familiarization and the sophistication of the borrower. And in terms of sterling, we have to say, well, what currency is the borrower really wanting to utilize? And if we come to look at the low carbon growth within Africa, there are obviously various types, but a lot of it, some of it will actually depend upon the use of equipment, the importation of equipment, which is denominated in USD. So there's a natural requirement by some of the borrowers in particular sectors, for example, some of the e-mobility sectors, the solar PAYGO that we're familiar with, but it could also be cold storage supply chain, solar irrigation, where a lot of equipment is actually denominated in dollars and that the borrower require. So, and obviously they also have requirements for their own local currencies. So the issue, what we're trying to tackle, which we are tackling, is how to provide borrowings to investees which are not in sterling but in dollars, and then in the future local currency. So they have a set of interest and capital repayments in dollars, whereas the investor is still expecting a return in sterling. So there's inherently a potential mismatch in terms of the currency risk. So as an example, if the borrower was to draw down a loan today at say 120, an exchange rate of 120 sterling to dollar, but when they came to repay the first annual, semi-annual repayment, so let's say the currency had moved to 130, the amount of sterling that was available to repay the investors would have fallen because of the exchange rate movement, a dollar depreciation in this case. So in order to address this problem, we need to look at what hedging instruments are in the marketplace. And there are two particular types. There are put options and forward contracts, which will set the rates in the future of the sterling and dollar when the payments are made by the borrower in dollars. At the moment, the product that we're leading on utilizes a combination of a match funder and a put option. So the borrower, so the investors will subscribe for, let's say, 85% of the loan, and the match funder will subscribe for 15% on the same terms. And when the loan is repaid in dollars, depending on the exchange rate movements, the crowd will always, the UK investors will always be repaid, but the match funder will take an element of the exchange rate risk up to the amount of their investment. If the exchange rate moves significantly, then that is covered off by the use of put option, which where we have the ability to sell dollars for a preset rate of sterling, which protects UK investors, but is clearly at the risk of the match funder. But clearly, if the exchange rate changes and the dollar appreciates, then the match funder will actually benefit. So the match funder is the first line of defense against the exchange rate risk. We are looking to pilot this product in the next 2 to 3 months, and it's only with the participation of organisations such as Good Energies that we can actually do this, who are actually looking to take a risk position so that can actually crowd in UK retail investment money. The bigger picture is that there are two elements to the bigger picture. The first one is that we are trying to help relatively immature economic sectors to grow and to establish a track record, which then improves the bankability of those borrowers in the future. And secondly, we are looking to increase the supply of finance from UK investors into products which they obviously have a credit risk, but we're trying to reduce and strip out the currency risk that they would have to maintain that return to them. And just finally, in terms of the bigger context, in the UK crowdfunding market last year, the report was out by the Cambridge Centre for Alternative Finance. The market size was around $12 billion, of which over $3 billion is for business lending, peer-to-peer business lending by UK investors into SMEs, which represents a significant part of the UK market. So there is an appetite for this type of activity. We want to enlarge and mainstream the impact elements of that market and redirect it towards low carbon growth in Africa.
Thanks, Shah. And I think that really underlines the need to address this mismatch between the currency of investors. You know, if there's billions available here in this country that is looking for, you know, socially and environmentally impactful projects, how do we get that into the currency that is actually needed for SMEs in the region? And that's, you know, a really critical point. So Fabian, perhaps, you know, you've been CFO of some fairly large companies in operating in West Africa and also now with MyAgro in Tanzania. Can you perhaps give us a flavor of what it's like from the perspective of the company and trying to manage the finances, why it's difficult to issue a note in sterling and have to repay in sterling, and why it's going to make it much easier potentially if you can have that in US dollars instead?
Yeah, sure. So the majority of companies, at least the companies I've worked with or rubbed shoulders with, have had their equity issued in US dollars, and with working in the kind of West African environment, operate in a global currency, or as in most of the West Africa, have the CFA, which is pegged to the euro, which means that if we're buying inputs or material with the debts, we'll be buying that in US dollars, and then the cash generated by those assets or inputs will be in local currency or local currency pegged to the euro. So that means if there's any depreciation between that local currency, the euro or US dollars, then the cash that we've invested, so $1 of cash, that £1 of cash that we've invested will come back as less than that, especially when we're looking at return on investment periods that stretch over 24, sometimes to 40 months. There's a significant amount of exchange rate risk that the company has to support. My background is mainly with scale-ups, startups, So obviously these companies have less access to capital than more mature companies, more established companies, which means that sometimes the decision is being made between cash being invested into operations or used to fulfill a gap between revenue and expenses, and then the cash that is invested into products. So obviously we want the maximum amount of this return on investment to come back and be used to pay for for operations, and then the excess to go towards paying back debt, interest, and then investing in more material. If exchange rate risk, or the cost of exchange rate and translating from US dollars, local currency, back to pounds is negative and significant, as it had been over kind of 2020, 2021, where the dollar dropped against the pound by about 12%. Then there's less capital to run operations, less capital to invest in products and the growth of the business. It's kind of a scenario that we've had to accept, but then we have products. There are hedging products for companies the size of Ulu, even MyAgro. Those products are quite expensive compared to the actual principal of debt that's being drawn down on. So companies of kind of SME size have to either price in that exchange rate risk into the products, which obviously has an effect for the final customer, the amount that they're paying, their economic return, but also the scale and lives that can be impacted. Or the company stomachs that risk itself and pays down, essentially subsidizes the customer, and this makes a company less of an investment, reduce the investment potential of the company for investors, right? And makes it harder to attract capital. Instruments like this that allow us to borrow or to repay in currency, either local currency or in US dollars, basically currencies that in which we work, allow us to reduce that exchange rate risk, pass those savings on to customers, and be increase the investment potential of the company and attract investment capital at better terms, and therefore pass those savings again on to customers and increase the scale and potential of the company to impact the lives of our customers.
Thanks. I mean, Stephanie, you touched on it briefly at the beginning that, you know, the role of Good Energy's foundation in providing blended finance is around kind of reducing the cost of the FX risk and that burden on the borrowers and ultimately on the end customers. And I think, Phoebe, and you've really done a great job of kind of expanding on what that actually means in terms of passing those costs on to what are ultimately, you know, base of pyramid customers, and or having to bear the cost within a small, you know, and growing organization, and the impact that that can have in terms of the growth and the great impact that the organization could be delivering if there was someone else in the mix to kind of manage and mitigate a little bit that risk. And so that kind of speaks to the need for partnerships and for blended finance and concessional capital when we talk about, you know, this low carbon growth and development in sub-Saharan Africa. Frank, it would be lovely to hear from you and, you know, from the perspective of the members of the Africa Venture Philanthropy Alliance on, you know, what is the role of blended finance and concessional capital, and perhaps also how you see that growing, you know, more investable opportunities in the region.
Yeah, so that's a really good question, and one which we are paying due attention to. So as I mentioned earlier, we have no choice but to look at how we can crowd private capital into a lot of the social investments. And so on one hand, we're trying to make sure that the private sector understands that profit and purpose are not mutually exclusive. And Africa, by the very nature of the challenge, the impact challenges we have, is a perfect place for you to come and test new models of packaging finance. So I always tell people, Africa is the Wembley of impact. This is where you can come and really play as a sandbox for impact. This is where you can practice your free kicks and your penalty takes and what have you, because in many ways we've got a wide array of opportunities and challenges which are a blessing in disguise to the impact investor and the impact world. On the other hand, in many cases in Africa, innovation precedes regulation. So you've got a lot of space in which to try out new things in that case. And I also, in the context of that, I also think there's a really nice and emerging change of the role of philanthropy in achieving impact. I think philanthropy today should kind of really play that high risk role of testing new markets, new products, new services, and take them to the proof of concept stage where more commercial capital can then pick it up from there. And that's something we're really trying to get our philanthropists to think differently in that context. So, but one of the things that's holding us back is basically this whole space of innovative finance that necessitates for us to bring together traditional grants and the grant-making world with private sector into this new blending finance middle ground, comes with a lot of need for us to learn new skills and new competencies, many of which a lot of our social investors in Africa don't know. I don't know if you know this, but if you wanted to take an innovative finance or impact investing program in Africa using an African university or an African institution of learning, you have one choice. In 54 countries, there's only one university that has an impact investing program, okay? And that's the University of Cape Town. So your other option is to go to Oxford, Cambridge, Duke, Stanford, whatever, and we know those will charge you an arm and a leg for some of those programs. So we've got to build our own institutions, capabilities in our own institutions to really move the needle on that end. So we are doing a really exciting program with a group called the Impact and Sustainable Finance Consortium faculty to take about 40 African business schools through a train-the-trainer program that will eventually get them to the point where they can set up their own departments of innovative finance. So when Tibian is working in Mali or wherever, he can have a local university to help him really drive in that ecosystem this whole concept of impact investing and sustainable finance. So when you go and talk about blending finance in various African countries, not something strange. On the other hand, we recognize that we need to build large pools of catalytic capital to unlock private capital. So on that end, our grant makers, majority in Africa, and that includes governments, are stuck in the old model of being just traditional grant makers, and we need to shift them to becoming catalytic investors. So once again, that is something that's very new in many places, but as AVPA, we've just got a grant from MacArthur Foundation as part of the C3 consortium to run Africa's first catalytic investment training from September. So we'll be taking African grant makers through the first catalytic training investment program that I'm really looking forward to in that context. And then we've got a couple of people who are coming to us to try out new models. So we've got a group of US investors who have come to us to test 3 sector-specific catalytic pooled funds. So they'll come in with about some money to seed 3 funds, one in WASH, one in agribusiness, and one in healthcare. We're trying to see if we can get some more people to do something in energy, fintech, and education. But fundamentally, these catalytic pool funds will then act to try and offer that early stage capital. And we believe over every 12-week cycle, we can, for each of those funds, we can, even at a very minimum size of the fund, we can take about 15 businesses through an investor readiness program. After which we can then plug them to a broader ecosystem of investors who follow on capital. And each fund will be able to churn out about 75 businesses every 15 months. So there's a lot of innovation happening in that space, and we are really at the call phase of driving the adoption of impact on the continent. We're running an impact investing fellowship program with Oxford that is starts in September this year, that will be looking to take asset managers and asset owners in Africa through a 4-month impact investing program. And then we've been asked by Boehringer Ingelheim to do a similar program, but just for healthcare investors. So we're now getting into deep dive verticals or sector-specific programs. So there's a lot we're doing in this space. And that's why for me it's super exciting. There's all this stuff just leads to some extreme and high-level upside for the continent. But I'd really like to thank the UK investors and Energise Africa for the work you're doing around this. And I know we've got some hurdles we need to jump through to deal with the forex risk and that, but there's nothing that's insurmountable, I believe.
Great. I mean, it sounds like you're working across the whole ecosystem, and congratulations on the MacArthur grant. I think, there as well, you touch on the need to support companies to become investment ready, but, also about teaching investors what it means to invest responsibly and to support sustainable finance initiatives. We see a lot of activity around how we're supporting companies and startups to really address those climate challenges and the social challenges also that we see. But actually it also needs to come from the top. How do we as investors think about really supporting these initiatives and enabling these initiatives to grow to achieve the impact that they can. And we've had a question here in the chat around kind of the limited number of new investment opportunities on Energise Africa. And what is stopping the growth of investment opportunities. I mean, I think, Frank, you've touched there on some of the work that you're doing in supporting companies to become more investment ready. But Shah, perhaps you could maybe talk a little bit about some of the challenges that we specifically as Energise Africa have encountered in terms of bringing new companies to the platform and providing finance for them.
Yeah, so just in terms of our sort of direct experience, so as mentioned, we raise in sterling and we lend in sterling, but we're looking to diversify that into non-sterling. So there's a natural hesitancy in terms of some of our investees to deal in a currency which they're not overly familiar with. Some of our investees are sophisticated and they can take a view as to what the interest rate differentials and exchange rate movements might be over the next, say, 2, 3, 4 years, and are comfortable with that. But that is, I would say, a relatively small subset of the type of investees that we're looking to provide funds for. So the natural, if you like, the natural pool of potential investees in our current model limits itself. That's a very important point. And therefore, by diversifying our currency offering, it will actually increase that pool, hopefully fairly significantly. I think the second, so that's an external issue. Internally, we are ourselves a scale up, and we take 3 to 6 months to do due diligence and become comfortable and have relationships with our investees. That is a fairly long process. We consider ourselves to be just as good or better than a bank who may be making these type of credit assessment decisions in what is a high risk environment, and that naturally means that we are only looking for those type of investees that we are comfortable with and that we believe can meet the expectations of our investors. So that naturally, as an internal issue, would actually reduce potentially the available pool. That said, we have the mindset of helping high growth companies in what is a still maturing sector, depending on the country that we're talking about in Africa, so PAGO and CNI. So there's a whole host of reasons why there may be slow growth in the numbers, but we believe that the product development will help accelerate access to new investment opportunities and access to new borrowings by investees.
Thanks. And just to remind the audience to please feel free to kind of keep other questions coming through. in the chat. Frank, perhaps you could maybe talk a little bit from your wider sort of investment membership around what the opportunities are, and perhaps what your members are saying around what could be done to bring through more investable opportunities across the region.
Yeah, thanks. So we always hear this all the time, that that Africa has more capital than there is investable pipeline. This is a very common statement we hear everywhere. And I think it's, yes, there's some truth to that, but there's also some truth on the supply side of things, where I don't think investors come with enough variety in their toolkit of investing capital. And this is why some of the investment readiness programs we're running are so important, so we can expand the tools that investors come with. Within the blended finance space, it opens up a wide range of tools that we could utilize, for example. And our network, by the fact that we have providers of grants, debt, and equity, we are able to collaborate with the unusual suspects in funding some of these deals. So I think there's something around the supply side where investors need a bit more flexibility and knowledge on the tools available to them, as much as we're working on the demand side of things with entrepreneurs to make sure that they understand what investors are looking for and they set themselves up for success in that context. So I think it's something to do with both sides. On the issue of the opportunities disappearing very quickly, I'd like to make people aware that we recognize that sometimes that can be a challenge. So we have a deal share platform on our website, and I'll put a link in the chat, where we showcase investable pipeline. And because AVP is an investor-only community, all the deals on our deal share platform can only be listed by an existing investor of the deal who's looking for additional growth for capital for growth or scale. So all the deals you find on our deal share platform have an existing investor who's looking for co-investing or a co-investor. So that platform is designed for people who are already investing in Africa, or people who are coming in with capital and looking for investment opportunities, or to look to plug into a community of investors. Our deal share platform works very well in that context. So we're trying to make sure that we can address some of these issues at scale across the continent.
Yeah, and actually, I think your deal share platform does exactly what Good Energies Foundation has done for our retail investor audience, in terms of saying, look, here is a reputable investor who's already interested in this deal. And so it's about, kind of building the confidence and bringing others along on that journey. Frank touched briefly there on the kind of toolkit that that investors have available to them. And Stephanie, with Good Energies Foundation, you've done a huge amount of work in enabling Energise Africa to have a much wider toolkit than we would otherwise have had. Can you perhaps talk a little bit further about what you've done with Energise Africa, but also in some of the other initiatives around sort of building out that investor toolkit?
Yeah, thanks. I just wanted to point out that it's exactly as Frank said, what the investors are offering sometimes is very narrow, right? Whether it's the deal size or the interest rates, and it just doesn't cover a very broad spectrum of the enterprises and what they're looking for. So even Energise Africa is sort of plugged into a very specific part of the market in terms of the kind of company, the growth stage they're at, which leaves a big gap then to more, larger impact investors or commercial investors. And I'd say at the other end, there's also companies that are even smaller and starting out that need very small amounts of money. And as you get smaller, of course, the sort of the cost of the due diligence relative to the loan is even higher. I think we have one of our other grantees on the line, Charm Impact, which is aiming at some of that even smaller size loans. But again, as Energise Africa is trying to make sure that the interest rates are affordable to those enterprises, and they typically are, especially compared to what they could get in the local market, but also that a lot of that risk of the loan is covered by philanthropy, and that's our role there as well. So I think having more facilities that are subsidized with concessional capital that can cover sort of the full spectrum of capital needs of the enterprises is really important, and help them along that path of, the first 10,000 pounds they need, the first 20,000 up to 100, all the way up to the big investors that are coming with $5 million ticket sizes.
Thanks. And you touched on interest rates there, and there's been a question in the chat as well. So Stephen, perhaps from from the perspective of a CFO at the companies that are raising finance on these platforms, could you perhaps talk a little bit about interest rates that you can get from different types of lenders, and what the options are and what that might mean for your company?
Yeah, so I mean, the interest rate is going to depend on the sector, geography, and also the maturity of the company and the amount of cash reserves, equity that it has to make sure lenders are happy that the company can repay. But typically, the pecking order goes with unsubordinated debt, so debt not backed by any assets. They're looking at low teens in terms of interest rate, and then sometimes that could be partnered with any form of these investments can be blended with grants or investors who are willing to take first loss, which can reduce the blended. But in terms of pure interest rate, unsubordinated debt, we're looking at kind of low teens. Then you have subordinated unsecured debt is low teens. Then you have secured debt, which is typically available from banks, and then larger organizations, DFIs, international commercial funds, which you can be looking at kind of high single digits. The caveat being that these funds, the lowest that they'll be looking to invest are maybe like 5 to 7 million, going up to probably a preferred ticket of above 10. So only available to a certain size of companies with a certain amount of track history and equity. And then in terms of other financing, you have equity, you have grants. Talk about blended finance, package these together in a number of ways to come out with a more palatable kind of cost of finance. The issues that companies have is kind of at the earlier stage when we're looking to create track records, and in order to create track records, we need cash, and that cash is not really available. So there's a kind of a vicious cycle here that you need to work through by partnering kind of medium, long term with organizations such as Energise Africa, willing to, based on good due diligence, willing to look at characteristics of a company that are less tangible, that can show the potential of a company to grow, repay debt, and importantly, raise further financing. And then also look to other sources of capital like grants and joint ventures to fund that early stage of concepts, proving concepts and scaling in the market.
Can I just add a couple of things onto that? So I think also it's around flexibility. So it should just look at the price on the tin, so to speak. So we, in terms of our credit facilities, we will supply a credit line to an investee, let's say 2 to 3 million, it can be higher. The range is 1 to 5, but typically it's around say 2 to 3 million. sterling, and that credit facility is available for 18 to 24 months. And within that time period, the investee has the flexibility of when they wish to draw down that credit facility through the issuance of bonds or loan notes on our platform. And I think there is a value to that flexibility. And then just to put the interest rate in context, if you go onto a UK crowdfunding platform such as Funding Circle, which you'll be looking to supply loans to UK SMEs, you are earning a return of say 4.5 to 6.5%. So in terms of a differential, if you're the investor, clearly there is a positive differential for the Energise Africa loan notes. But there is a difference in risk, as we've been discussing. And I think there's also a difference not only in terms of the return, but also that part of that return to the investor is in the form of environmental and social benefits, which they value as well, and that's very important. So I just wanted to mention those couple of things, really.
Yeah, and I think we've had a question here around kind of investees delaying payments and what kind of default rate we might anticipate in the coming years or in the current year, given the current financial crisis. And this kind of comes back to how we talk about the need for patient, flexible, and affordable capital. And that flexibility is really, a key part of what Energise Africa and other similar initiatives are aiming to provide. And, also I think a critical part of what we're able to do through the auspices of organisations like Good Energies and the UK aid funding that we receive is to take a kind of more flexible position and to work with companies through some of these crises, from COVID through to the current financial crisis, in terms of understanding, where the business is currently at, and how we can kind of help them to get through and see to the other side of that. And it's really, I think, important, in this discussion to look at the use of blended finance, be that, first loss or the first time investor guarantee that we've been able to develop in, enabling us to support a lot of the SMEs on the continent who are facing, some very major challenges here. And to manage some of the late payments that are coming or that we are beginning to see on the platform. I think it's very difficult for us to talk about what will be coming in the year ahead. I wish I had a crystal ball. But a very important part of what we've been able to do with the concessional capital and the support from organisations. Shah, you're also doing some work on product development there, so if perhaps you could touch on that.
Just a couple of points, because it's very important. So just in terms of sort of what we're trying to do here at a high level is to scale up and get to maturity sectors of economic activity, low carbon in this case in Africa. And that is clearly high risk, and there will be defaults and late payments and restructurings, and that has to be accepted as part of the landscape. But in terms of the importance of risk mitigation to reduce the impact of that, my direct experience is that I believe that there is a significant gap between what the money available and what can be done with it in terms of from our DFIs. So in terms of our development finance institutions, I think that there could be a step up, frankly, in terms of urgency by these type of organizations to produce programs which are proactive, hands-on, to help de-risk some of the investments that the type of investments we're talking about at scale. So Good Energies Foundation is very much in the vanguard of this. And I'm really hopeful that we can demonstrate that these sectors genuinely need to really scale. They genuinely need the big beasts, so to speak, to come in after what we hope, is a successful pilot of what we're doing. It's very important. I lost my train of thought there. There's going to be another ad. I'll come back to it when I think.
Well, I mean, we do need to wrap up now, but I think, you know, Shah, you've given us a call to action there, a need to step up on the blended finance and the climate finance initiatives, you know, really take them to scale to achieve the great social and environmental impact that we think can be achieved, and, you know, capitalize on the wonderful opportunities that there are for low carbon development in sub-Saharan Africa. So I hope that that's been kind of a good helicopter view of some of the work that Energise Africa and our partners have been doing around harnessing the power of UK investment for the region's low carbon future. I believe we've been able to answer everybody's questions in the chat, but if there is anything that you haven't had answered, do feel free to reach out to either myself or Shah. We'd be very happy to kind of pick them up at the end of the webinar. And with that, an enormous thank you to all of the panelists and to everyone who's joined us during the session today. And I hope you enjoyed.
Great. Thank you so much, Usona, for hosting.
Yeah, excellent. Thank you, Sharon.
Great.
Thanks.
Thanks, everyone. Take care.
Thank you, Ron.
Right.